morning. You're watching a live market outlook for Thursday, 24th of November 2011, prepared by Windsor Brokers. Bleak outlook for Eurozone with some more black clouds coming over is today's outlook. Today's the most significant information, as disastrous German bond sale yesterday now sparking fears that current debt crisis in Europe is starting to threaten even Berlin, with the leaders of the Eurozone's biggest economies still at odds over a longer-term structural solution. With contagion now spreading, a majority of 20 prominent economists polled by Reuters yesterday predicted that the Eurozone was unlikely to survive this current crisis in its current form, with some envisaging a core group that would exclude Greece. Investors were also unnerved by reports that Belgium is leaning on France to pay more into emergency support for failed lender Dexia under a 90 billion euro rescue deal that had appeared done and dusted. A special report also by Fitch ratings agency suggested that France had a limited room left to absorb shocks to its finances, such as a new downturn in growth or support for banks, without endangering its current top AAA rating status. The German Chancellor Merkel, French President Sarkozy, and the new Italian Prime Minister Monti were to meet today in the French city of Strasbourg, and they are expected to discuss the reforms planned by former EU Commissioner Monti at a meeting they hope will allow Italy to put behind it the era of scandal-plagued former Italian Prime Minister Silvio Berlusconi, who resigned last month. Underlining how deep the Eurozone crisis has become, a German debt agency could not find buyers for almost half a bond sale of 6 billion euros. That pushed the cost of borrowing over 10 years for the bloc's paymaster above those for the United States for the first time since October. The comments on the analysts say that this is a complete and utter disaster. The new bond promised to pay out 2.0% interest rate, the lowest ever on an issue of German 10-year bonds. The auction's average yields was 1.98%, down from 2.09% for the previous benchmark in October. From the other side, some positive, I would say, tones are coming from the Organization of Economic Cooperation and Development, OECD, whose president was quoted from his interview in the newspaper saying that economic recession can be avoided in Europe, but resources are needed to calm the financial markets. In an interview to Italian newspaper La Stampa, Piercarlo Padoan, who is the chief of the OECD, said next Monday's OECD forecasts will present lower and very weak growth projection based on a negative scenario and reflecting the serious financial crisis in the Eurozone. He says that recession still can be avoided, but at the European level there is a need for sufficient resources to calm markets, and governments have to go forward with austerity measures. If this happens, he said, we can not only exit the crisis, but start again a more sustainable and stable growth path. The European Central Bank has played an essential role for the stability via its bond buying and supplying unlimited liquidity for money markets and banks, he said. But also European Monetary Fund is needed to give money to countries in exchange for set conditions. As mentioned, Wednesday's week German bond auction represents a further worsening of the crisis. As today's public holiday in United States, Thanksgiving Day, we expect some lower speed of the market with obviously lower volumes, especially in the late hours, as the absence of the biggest world market might affect today's performance. Also, week calendar for today, just a few events due. German IFO business climate, it's due at 9 o'clock GMT, so in approximately 45 minutes, and the forecast for today is slightly lower, 105.3 compared to 106, pardon, 0.4 the previous month release. And then we have the revised GDP, quarterly GDP for UK due at 9:30 GMT, expected to stay unchanged at 0.5%. Also from UK, at the same time, preliminary business investment quarterly expected to decrease by 0.5% compared to the previous quarter's strong growth by 11.6%. That would be, pardon, there is UK also at 12 o'clock GMT CPI industrial order expectations that are forecasted slightly lower from the previous release of -18. Today's forecast is -19. And this would be all for today's calendar. As I mentioned, the US is shut for the holiday, and some lower volumes, I would say, are expected on today's trading action. Now let's go to the technical part and see the latest movements of the majors and commodities in the past 24 hours. The euro remains under pressure after losing its key supports at 134.21, 134 zone. In steep decline yesterday, extending losses to 133.19 low. So far this is fresh 7-week low. Current correction higher, bounce higher on the oversold hourly conditions is seen corrective, with much of resistances coming at 134, 134.20, and also the Fibonacci retracement, 50% Fibonacci retracement of the yesterday's down leg from 135.29 down to 133.19. We have the 50% Fibonacci retracement at 134.23, as well as along with the previous lows at 134.21. So we have actually the strong resistance here, and the reversal here actually is anticipated, as investors are expected to start selling again from this level. However, the further extension higher might face 134.50, 134.70 resistance zone. The first one is 50% Fibonacci retracement. Then we have the main trend line, bear trend line from 142.46, which started at 134.86 actually, and 134.70.80. So between 134.50 and 134.80 we have another series of strong resistance points that are expected to contain the current corrective bounce. As the wider picture outlook shown on 4-hour chart shows the bears firmly in control, and the 20 days moving average at 134.50, currently maintaining the bearish tone. Break below yesterday's low at 133.19 to open next level at 132.42, ahead of possible stretch to key support at 131.45, as shown on daily chart, which whose studies also are firmly in bearish field, and the 20 days moving average now crossing below 55 days moving average, confirming the bearish stance on the for euro dollar. Cable also maintains strong bearish tone with the latest decline from 160 zone, extending yesterday through previous supports at 156 and 155.80 to briefly test the levels below 155 level. 154.93 seen so far low, and mild correction that followed the hit 155.56 only, with fresh weakness now underway, and likely to retest 155, 154.93 before extending losses lower towards 154.20 initially, and then we have the last barrier before 152.71 low, which is at 153.40.30 zone, ahead of test of the key support at 152.71 6th of October low. The daily studies also are firmly in the bearish mode and keep the downside favored for possible short-term stretch retest of 152.71. Dollar yen again lost traction after yesterday's strong rally that briefly broke above initial resistance and the previous spike high at 77.50, with gains stalling at 77.57 and subsequent pullback returning price action down to 77 zone in the initial level where the latest rally started. The hourly studies are losing power again, as we see that MACD is now attempting to break below the midline, and the 20 days moving average currently capping the upside for now and maintaining the recent weak tone. Only regain of 77.50 would be supportive for euro at this point, and look for a fresh extension higher and to test the key barrier at 78.00. Otherwise, we might see the fresh attack at the congestion level at 76.50 zone, as the daily outlook is still holding a slightly negative tone and favors the downside at this point. The dollar Swiss 92 level seems to be quite a strong barrier at this point, as the strong rally from 91.05, the latest higher low posted on 22nd of November, again was capped at 92 zone. 92.12 was seen ahead of a reversal that initially tested 91.65 zone, just ahead of the near-term trendline support drawn from 91.45. Formation of a triangle pattern at this point is currently narrowing the range of the dollar Swiss. However, the outlook is still skewed towards the upside, and the main focus remains at 92.00 as our initial barrier, break of which is required to reopen the previous high and the strong resistance at 92.34, and then to resume the broader uptrend and focus our short-term targets at 93.13 and then 93.38 highs. At this point, only loss of trend line at 91.60 and the break below 91.20, the main trend line support, and the 91.05, the previous low, would reattract key support at 90.83, a low of 18th of November, below which would turn the short-term outlook bearish and possibly for possible extension down towards the psychological support at 90.00. And crude oil, the latest action lower is so far being contained by 200 days moving average seen on the daily chart, and holding above here would keep immediate strong bullish stance in play, and likely to reattract levels at 100 and the previous high at 103.35. Loss of this level firm break below 95.71, as we saw the 95.34, 95.23 lows were seen, but the market quickly reversed above the 200 days moving average. A loss of these levels would signal further retracement of the latest 74.94, 103.35 ascend and open next 94.50 and then Fibonacci Fibonacci 38 at 92.50, 92.50, holding, as I said, above 95.70, 200 days moving average keeps the focus still higher, and would look for a test of levels previously mentioned, 100 and 103.35. The gold is again on back foot. However, the 50% Fibonacci retracement of the broader 1532, 1802 rally is still holding the downside and keeps the hopes of fresh attempt higher in play, as the 200 days moving average still maintains the positive tone on the wider picture. However, clearance of previous highs at initial resistance at 1709. 17 zone actually is now our key barrier. 1710 is required to pick up the latest bounce from 1666 low of 21st of November, and possibly to look for test of 1737 and 1735, 1737, which is the short-term break point, in order to resume higher, above which we have 61.8% Fibonacci retracement at 1745 to refocus 1802. At this point, the near-term outlook is still under pressure, as the MACD is still below the midline, however holding above the center line, with RSI and the momentum pointing higher, but still holding below the midline. We need to see break above 1710 minimum in order to improve the near-term outlook.